The stock market is not an island and it doesn't operate in a vacuum. You will discover that activities in the market trends and sentiments are most of the times influenced by external factors. And these factors predominantly include political changes as well as central bank policies. So both changes in the country's body politics as well as regulations by the country's central bank will certainly affect the movement of stocks in the market. In this video, we are considering how political changes and central bank policies affect market sentiments. How political changes and central bank policies affect market sentiment. We want to look at number one, monetary policy and economic stability. Monetary policy and economic stability. In these regards, you consider interest rate changes. Central banks often adjust interest rates to manage economic stability. During political changes, if the central bank maintains accommodative policies such as lower interest rate, it can boost investor sentiments by ensuring economic stability. These can support stock market growth even amid political uncertainty. And so changes in interest rate will definitely affect the stock market one way or the other. We equally have quantitative easing. Quantitative easing. So in times of political upheaval, the central banks may resort to measures like quantitative easing to inject liquidity into the economy. They tend to inject extra cash to the economy to promote liquidity. This can prop up stock markets by lowering borrowing costs, increasing investments, and enhancing liquidity in the financial system. We experience a different level of QE, that's quantitative easing in the US market of recent, in the US economy of recent. Number two is the central bank's role in mitigating political risk. Central bank's role in mitigating political risk. In this particular heading, you consider policy coordination. Policy coordination. So central bank's independence and commitment to stability can help mitigate the risk associated with political changes. If market perceive that the central bank will act decisively to ensure economic stability, it can kind of positively influence stock market sentiment, even if political events introduce uncertainty. You discover that people are always very keen about what policies the central bank would introduce, considering the fact that these policies will certainly affect the market, and so people tend to act proactively. You equally have inflation control. Inflation control. So political changes that leads to uncertainty in fiscal policies may create inflationary pressure. Central banks, by adjusting policies to control inflation, can reassure investors and stabilize market sentiments. Not only that, you discover that effective inflation management can maintain confidence in the financial markets even during periods of political transition. And so the central bank is there to control inflation rates. And the impact of this control will certainly be observed even in the stock market. Number three is central bank communication and investor confidence. Central bank communication and investor confidence. There is this forward guidance. And when it comes to forward guidance, central banks use forward guidance to communicate their future policies and intention. you will discover that there's that clear communication which is aimed to reduce market uncertainty. It's aimed at reducing market uncertainty during political changes. And so if investors believe that the central bank is prepared to act in response to political development, it can foster a sense of security and reduce negative market reaction. Moreover, we equally have what is called market expectations. In market expectations, you realize that the central bank's actions and statements often shape market expectations. If investors believe that the central bank will take steps to support the economy, you would realize that during political changes, it can boost confidence and contribute to positive and stock market sentiment. And so market participants are always, looking at, keenly observing and following what the central bank is doing or what it intends to do. And the market will always react, either proactively or, after the policy is introduced to go about their trading, their investment in the market. Please subscribe to this channel and like this video. Number 4 is impacts on currency and international markets. Impact on currency and international market. So in terms of currency fluctuation, you discover that the central bank policies can influence exchange rate, and you discover that when it comes to exchange rate, you generally as an investor, you may invest in countries outside your own geography, and so in that case, discover that currency devaluation, currency fluctuation will come to play, to a larger degree. And not only that, political changes may lead to voluntary, to that it can lead to fluctuation and volatility, in the currency markets. But central banks, central bank can intervene to stabilize the situation. It's always there to see how it can bring stability to the economy, to currency fluctuation. And so political changes may lead to volatility, as we all know. And once that happens, the central bank will always come in to see how it can, salvage the situation. And not only that, we equally want to consider global investor confidence. Global investor confidence, central bank policies, particularly in major economies, can affect global investor sentiment. When we talk about the action of the Federal Reserve in the US, their action almost like influence every other country or most other countries in the world. It's not just restricted to the US alone. It affects other countries globally. And so political instability in one economy may lead to a shift in global capital flow. But coordinated central bank actions can help, reassure international investors and stabilize the global stock market. And so what happens in a particular country could have, effects far beyond that country. It's like what happened in Russia, the Russia-Ukraine war. So investors in Russia had to they sold their stocks and exit the country, completely. And even some companies were kind of nationalized, you see. And not only that, we have number 5, political events and central bank autonomy. Political events and central bank autonomy. The central bank actually should be independent of the government. The Federal Reserve is known to be independent, and in most other countries, the central bank, acts, as an independent entity. And so there's that particular perceived independence. And so during political transition, the perceived independence of central bank is critical. It's crucial, actually, the central bank ought to be independent and should be seen as being independent. As if market believe that the central bank is influenced by political pressures, it can undermine investor confidence and negatively, affect stock prices. If investors perceive that the actions of the central bank is being governed or controlled by a political class or the government, then investors may lose confidence and then sell off their shares. That will then bring, will cause a downward trend in the prices of stock in the market. As well, however, if central bank that is seen as being independent and focused on long-term economic stability will help to maintain, positive investor behavior. It all depends on the perception market participants have about or concerning their central bank. If they perceive it is independent, it will boost their confidence. If they perceive that the central bank is being, controlled, manipulated, or kind of influenced by the government, then it will lead to, investors losing their confidence in the central bank, and that will in turn equally bring about, lack of confidence, in the market itself. You have a market adjustment to policy shifts. There is, when it comes to political changes, this may lead to a shift in fiscal policies, such as changes in government spending or taxation. When it comes to taxation and government spendings, activities that comes under fiscal policies, and central bank responses, to these changes, such as tightening or loosening monetary policy, and this can influence market and market sentiments. The markets may react positively or negatively depending on how the central bank addresses the political changes. As you have shift in the political environment, the political climate, observers, investors will observe to note particularly how the central bank is trying to, put regulations and actions in place to be able to stabilize, the prevailing condition, political climate, and that will then go a long way in boosting investor confidence. And so, in conclusion, the central bank, policies play a critical role in shaping stock market sentiments during political changes. It does actually. So people look at how the central bank behaves, and then depending on the behavior of the central bank, that will boost their confidence to stay in the market or, sell off their position and exit the market. And so political change and central bank actually influence, market sentiments. And stock prices, unfortunately, most of the times is not influenced by fundamentals. Companies may have strong fundamentals, but if the political climate is not conducive, investors will dump their shares, and that will lead to a decline in general stock prices in the stock markets.